All right. It's a great day in South Florida. My name is Chris Igo, and today we are getting right into it because the Fed wants to crush you. The Fed wants to crush me. It wants to crush the consumer. It wants to crush the economy, and it wants to crush the labor market. And the only thing that I can absolutely guarantee is there will be an exponential increase in volatility across every market. Housing, stock, crypto, you name it, volatility's through the roof. And while that hasn't directly translated into the housing market yet, in terms of values dropping across the board, mortgage interest rates have absolutely exploded. And we're at 20-year highs right now as of today. Now, as a full-time, full-service real estate professional with an all-star team, I am contacted daily by people who want to know whether they should buy now or wait. And so today I'm going to go very deep. I'm going to cover that in its entirety so that I can educate and inform to help empower you to make the best decisions for yourself, for your family, and for your financial bottom line. Because the truth is, I don't know whether you should buy now or wait, period. But I can absolutely help you navigate through what's happening right now, looking at leading indicators today, which I think will help govern, inform, and help you decide whether it's right for you. And it's the exact same due diligence that I used for myself when purchasing a home in the last few weeks. And breaking news as of today, leading indicator, and actually I say leading indicator, it's not, this is looking back a month. Wholesale prices rose 0.4% in September, which is more than expected as inflation continues to persist. The Producer Price Index, which is the measure of prices that U.S. businesses get for goods and services that they produce, increased 0.4%, and the estimate was 0.2%, which I suspect the Fed will act hawkishly on tomorrow. And bond yields, which have a direct correlation to what you pay for a mortgage interest rate, are going to explode. Now, here's what I find to be absolutely shocking. For the first time ever, you can guesstimate what your mortgage interest rate will be by your credit score. And actually, that's not totally accurate. But right now, if you've got prime credit, meaning that you're in the bubble between 740 and 759, which is damn near perfect credit, you can expect to pay 7.5%. On a 30-year fixed, which is absolutely crazy given the fact that we were at 2.5% to 3.5% not that long ago. So getting back to should you buy now or wait, if you cannot handle the financial responsibility and contractual burden of a 7.5% interest rate, and you're buying because you're marrying the home and you're dating the rate, don't buy the home because you can't afford it. And anybody telling you to do otherwise needs to be fired immediately. And yes, there are absolutely strategies that you can utilize in today's market, given the changing dynamics and sellers' willingness to negotiate now more than ever. There are absolutely ways that you can reduce your mortgage interest rate. But hope is not a balance sheet item, and hoping that you're going to get a reduced rate and hoping that you're going to be able to afford this home at a reduced rate now, and you negotiate a favorable interest rate, you pivot to a different financial mortgage product, which allows you to take advantage of a lower interest rate for a short period of time, but then it resets to the higher number. If you can't afford that higher number, this is a terrible strategy. Don't do it. Because in perfect market conditions, yes, maybe that will work out for you, but we're not in perfect market conditions. We are trending into the most volatile economic period that we've ever experienced. Full disclosure, I'm not an analyst and I'm not an economist and I'm not a Fed banker. But when the International Monetary Fund's Director of Monetary and Capital Markets sees a 20% downside from here on top of the last 20% correction that we've already experienced, we must pay attention.
Well, that's a very good question, and it's a very relevant question at the current juncture. Inflation is very elevated globally, so central banks are tightening monetary policy, and an intended outcome of the tightening of monetary policy is to tighten financial conditions. So we have seen that interest rates have increased, interest rates on mortgages, for corporate credit, and equity markets and risky asset prices have gone down. All of these are intended consequences. But of course, what central banks try to achieve is an orderly tightening of financial conditions. And at the moment, what we're seeing are pockets of dysfunction. And that is very concerning for central banks. This is when central banks step in order to restore orderly market functioning.
I love the way you neatly avoided referencing Lehman, but the concern is that these things just don't blow up in one go. You get some tells before that, and it starts with markets which are drained of liquidity being unable to process business.
I'm going to jump in right there and discuss the liquidity crisis that is absolutely happening right now and get into what he just said about orderly market function. Because in my former career, I was a stockbroker for 18 years. And I experienced the last financial crisis in real time trading equities for my clients. And orderly market function was not something that was happening during the financial crisis. It was absolute chaos and panic and fear and uncertainty. And to be clear, I'm not sharing that to scare you. I'm sharing it to prepare you. Because when the consumer does not trust the banks, does not trust financial institutions, and doesn't believe their money is safe, they pull their money. And if everyone pulls their money at the same time, well, then the banks don't have money. And when banks don't have money, they shut down. And when the consumer doesn't trust financial institutions or banks or that their money's safe, they don't buy anything. And if the consumer doesn't buy anything, our economy fails. It is really important that people remember that Bear Stearns said they were absolutely fine and they were perfectly well capitalized up until the last minute when they failed. So if the expectation is that any of these banks or financial institutions that know they're in real trouble are going to tell the truth, then I need you to wake up, because they're not going to. And the Fed wants to crush you. And while I don't believe they actually want to start a depression, they're following the exact same roadmap that they did in the past to create one. And right now, at least in my market, most homeowners still feel somewhat wealthy. And to be clear, they feel a lot less wealthy than they did when their 401ks and their IRAs and their stock accounts were much higher. But putting that to the side, most of the homeowners that I speak to on a regular basis believe they have some wealth left because their homes have not depreciated in value. And real estate and housing values and the housing market are lagging indicators. So to put that in perspective, if you go look up your stock account right now, you can see how much you're down right now in real time relative to what you paid. And most homeowners who go through that exercise are also going straight to Zillow to see what their home is worth today. And to be clear, Zillow's estimates are total garbage, and anybody who's relying on Zillow for accurate information about their home's value needs to put the pipe down, because those numbers are always wrong. But the perception is the reality. And while I've shared a lot about what I expect to see in the future in my housing market, very few people are underwater on their mortgages. Almost everybody is sitting with lots of equity, at least for now. But how much does that help them when the stock market goes down another 20 or 40 or 60%?
People forecast the economy, et cetera. The IPO market closes first. That's kind of happened. High yield closes second, and structured credit, that's kind of happened for the most part. Things can get done. The early signs of distress. So you saw it. I mean, this again is fairly typical. Markets go down. People forecast the economy, et cetera. The IPO market closes first. That's kind of happened. High yield closes second, and structured credit, that's kind of happened for the most part. Things can get done, and then it starts to affect other credit. You saw the gilt markets here. You see a lack of liquidity in a lot of markets. A lot of intermediaries can't intermediate like we used to because of regulations. It is going to happen. And I think the likely place you're going to see more of a crack and maybe a little bit more of a panic is in credit markets. And it might be ETFs, it might be a country, it might be something I suspect. If you make a list of all the prior crises, sitting here, we would not have predicted where they came from. But I think you can predict this time that it probably will happen. And so if I was out there, I'd be very cautious. You need money, go raise it.
What about stock markets? Where do you see the trough for the S&P 500?
Oh, I don't know. No, okay. It may have a way to go. I mean, it really depends, that soft landing, hard landing thing. And since I don't know the answer to that, it's hard for me to answer that. But it could be another easy 20%. And I think like the next 20% will be much more painful than the first. Rates going up another 100 basis points are a lot more painful than the first 100 because people aren't used to it. And and I think negative rates, when all is said and done, will have been a complete failure.
Now, I'm fully aware that Jamie Dimon is talking about credit markets, he's talking about the stock market, and he's talking about another 20%. So the housing market in a vacuum hasn't really changed very much, at least not in my market yet. Yes, supply and demand has shifted, but when the consumer is down an additional 20% from here in the stock market and mortgage interest rates are at 8 or 10%, and home prices have not gone down because sellers who are in at 2, 3, 4% have zero interest in selling, what happens next? More appreciation. And the only thing that will unhinge that is forced and distressed sales, meaning the pain of inflation, of potential job loss, and equity destruction in every other market. Until those things happen, there is no fire sale. There is no half-price homes. But when it does happen, you can bet your sweet bippy that all of those things will come true. Now, recently I did a video about black swan risk, and I'm not going to go deep into that right now, but I will link it at the end of this video so you can check it out. A lot of the things that we talk about in terms of risk are defined, or at least predictable. But COVID wasn't predictable, and 9/11 wasn't predictable, and the Russia-Ukraine war was not really predictable, although some might argue that it was. But you know what else isn't predictable? Whether Putin will use a nuclear weapon or what China will do with Taiwan. But a hot war is no bueno for the housing market or economy, especially the way we are capitalized now with trillions and trillions and trillions of dollars of debt. But I think it's very important that we understand where the banks are at right now in terms of capitalization, in terms of earning, in terms of outlook, so we can start to read the tea leaves as to what might happen in the housing market, or really in the economy in general. And bank stocks are getting crushed. They're entering the third quarter in miserable shape. And as you can see in the breaking news that just happened, the FDA authorizes COVID booster shots for kids as young as 5 years old. Give me a freaking break. I can tell you whose kids aren't getting those shots. Mine. And big banks are underperforming. And we've got JPMorgan Chase, Citigroup, KeyCorp, Bank of America, Comerica, and PNC all releasing their earnings soon. And their price to earnings has gotten completely demolished. Well, please know that's going to get worse. Now, Jamie Dimon talked about the credit risk that exists in the market, and Credit Suisse has been in the news a lot recently because there's some major concern about their ability to service their debt. And the embattled lender is embarking on a massive strategic review under a new CEO after a string of scandals and risk management failures. And they're going to give an update on the 27th, along with their earnings. But they took on $5 billion worth of risk exposure to a hedge fund which collapsed. And although they are saying, some analysts are saying, this is not a Lehman moment, what happens if it is? Because if Credit Suisse fails, there will be disorderly market function, which is what the IMF said in the first video. But I'm going to say it a little bit differently. There will be a run on banks. Investors will pull their money out of institutions because they don't trust them. And the Fed will have achieved their goal of crushing the economy, and me and you and the consumer. And what's the unintended consequence of all these different factors? It's that demand for riskier mortgages is exploding, and demand for conventional mortgages has fallen off a cliff. But all eyes are on the Fed and the inflation report that comes out tomorrow. And the only thing I can guarantee is massive volatility. But what does that really mean if you're looking to buy now? Should you buy now or wait? If you're a longtime subscriber, you know that I recently bought a home. And the due diligence that I put myself through is the same series of questions that I ask anybody who's looking to buy a home right now. And this due diligence and analysis is not particularly complicated. The first question that I ask myself and then anybody else is, can you afford it at today's interest rate? Then, do you have job security? Are you confident in your financial future with your employer? And if you're self-employed like me, do you have visibility in terms of your financial future moving forward? And then from there, I want to make sure that I'm not house poor and they're not house poor. Meaning, is the mortgage payment associated with the home going to cripple them from a lifestyle perspective? And if it is, then don't buy the home. Wait. Then I want to ensure that whoever's thinking about buying has savings. Do you have certainty that if, God forbid, everything changed, do you have a few years of savings to be able to ride out whatever economic storm. And then from there, what is your timeline? How long do you intend to be in this home? And the question that I ask everyone is, and it's hypothetical, if the day after you close and you move into your dream home that allows you to max out your dream home and dream lifestyle forever, if the value of the home went to zero tomorrow, would it really change anything? And yes, I'm aware psychologically it would definitely change some things, but I use it to illustrate a point, which is that if everything about the home is intact and it checks all the boxes for you and your family to live your best life now, and your intent was to live in that home for the next 10, 15, 20 years, then never look at your home's value. And I say that somewhat sarcastically. The truth is, if your intent was to max out that home for the next 15, 20 years, even if the market did go to zero, when you want to sell 15, 20 years from now, whatever economic storm and market crash we've experienced will be far behind us. And those half-price homes will have doubled, tripled, or quadrupled. Now, I hope you found this content valuable, and if you did, please give it a thumbs up, share it with a friend, and subscribe. And just know that I love you for it. And check out my next video because I suspect you'll love it a lot. And until next time, peace.